Good day, Tea with Travis. Today is Thursday, December 4th, and boy, a lot of news on the market. If you've turned on the news at all, I think it's pretty much out there now. It leaked out about 36 hours ago. I saw the first article in Bloomberg News. It's a financial type news service, and it's leaked out now to USA Today as well as Wall Street Journal. And the talk of the leak is from the Treasury that the Treasury is considering, and most likely now they're going to have to buy down and purchase people's rates on a purchase down to 4.5%. And this is unprecedented, never done before. And there's some concerns with that. Obviously, that would be wonderful for the economy if the Fed would step in. And again, it's not a bailout. There's some concern about, gosh, if the Feds offer 4.5% on a rate or buy down mortgage available to homeowners to get that rate, then it's the taxpayer is paying for this. Well, the reality is they're going to offer bonds at 3% and then offer the loans at 4.5%. So a person could get a guaranteed 3% return in the market if they buy these mortgage-backed securities, and then turn around and Feds offer them at 4.5%. So there's a 1.5% arbitrage created by the Feds if they do this. So the concept is bold, but the problem is that there's three problems I see with this. One being, if this doesn't hit the streets for 6 to 8 weeks in January, right now the idea is that President Bush will not sign off on this, and so it might have to wait till the new administration comes in January. Well, if that's the case, then nobody's going to do anything. Nobody's going to sign up for a 5.25% rate if they know they're going to get 4.5% in 6 weeks. So it's going to create a complete standstill in mortgage applications for refinances and purchases. The second problem is, in both articles I've read and everything I've heard, has pointed to this being a program for purchases only, not refinances. So that in itself is a big dangerous thing. The National Association of Realtors have really been lobbying to get this some help with foreclosures and just getting the market moving again. But it's only addressing the purchases. So the people that are currently either lost their jobs or are upside down in their mortgage or in their equity, this doesn't help the refinance people. So hopefully they're going to put them all bundled together. Otherwise, the third problem I see with this is what's happening now with some of the FHA programs is what they call a buy and dump. And what that is they buy a new loan or buy a new home that's been dropped considerably in value. Let's say their neighbor's house goes into foreclosure. It's worth half as much as their house. They go buy the neighbor's foreclosed house, and then they walk away from their home. They don't care if their credit's damaged. They think, well, hey, we got a half-price deal with a low rate for the next 30 years. What's the harm? So that's the third quandary in this. So there's some really interesting dynamics to this thought. The Dow's Dow and the mortgage-backed securities are flat this morning, really based on tomorrow's numbers, based on the unemployment numbers, how they come out and how they look. Right now, the Dow's up 30. Mortgage-backed securities are only down 9. They've been kind of bumping back and forth in the red and black, but just really flat this morning. Not a lot of trading going on. What's interesting about this Fed offer to get rates down to 4.5 or even lower is that the announcement last week, and the reason for the drop in rates last week, was the Fed's announcement of putting $600 billion available to back mortgage-backed securities. So that might have been the initial steps or foundation to create this ability to do this. So it's pretty interesting to see this happen. Also last night, pretty interesting, European Central Bank, ECB, and the Bank of England both did slash their discount rate last night, or their basically their Fed funds rate. England cut theirs by an entire 1% from 3% down to 2%, and the ECB went from 3.5 down to 2 3/4. So it's a 3/4% drop. So what that does, again, it strengthens our dollar. When our Feds meet next week, or the 16th, most likely they're going to cut our short-term rate, our Fed funds rate. And so I was concerned that mortgage rates might bounce up, which they typically do when the Feds cut short-term rates. But when other global economies are cutting their rates, it takes pressure off our rate. Already this morning, oil is down $1, down to $45 a barrel. And so with that, we're going to see gas at $1.50 a gallon at the gas pump. So that's pretty exciting news. Outside of that, tomorrow is the jobs numbers. That's a big thing to watch for. We're all kind of anticipating, waiting for that. But this news is hitting the wires with this interest rate cut on mortgages on purchases. So, boy, those of us in the industry are going to be in for a ride if that really happens. So that's the update for today. Again, stocks are flat, mortgage-backed securities are flat. Probably won't see any movement until tomorrow. The big three automakers are back on Capitol Hill this morning asking for a bridge loan to avoid bankruptcy. So all kinds of stuff going on. So stay tuned and be back in tomorrow. And just give us a call if you have any questions. We look forward to serving you. Have a great day and be blessed.